Back in chapter 8, I talked about a dynamic money management method which allows me to increase my risk per trade when I see a setup with the highest probability. Traders often call them perfect setups because it ticks every box and has all the right conditions behind it. Does this mean that this setup will always work? No, not at all. What I mean by highest probability is that out of 100 perfect setups, a very high percentage of them will be winners. Knowing this fact, I turned to mathematics to find ways to maximize this edge. I found the Kelly criterion to be part of my solution. John Kelly Jr. developed a mathematical equation which professional gamblers applied to work out how much they should bet when the odds are in their favor. I will save the complex mathematics for those who are interested. Here is the equation. For example, if my strategy has a 40% win rate and on average a win is twice as big as a loss, then the Kelly equation would give me a risk per trade of 10%. You can probably tell why gamblers use this equation. Risking 10% on every trade is a sure way to get wiped out. On its own, it is not suitable for trading. However, with proper application, it can become useful. I split my account into two smaller accounts. One holds 80% of my balance while the other holds 20%. When my analysis shows that a setup qualifies for the Kelly equation, I would take that trade on the smaller account and I would risk 10%, in this example, of the smaller account total balance. I think of it as my offensive weapon. I am increasing my potential to win more while keeping my overall risk as low as possible. It is a balancing act between techniques that can minimize losses and techniques that can increase profits potential. Most traders only focus on maximizing profits in the short term without realizing that it is much more profitable to survive the losses and cash in on the big wins in the long term. Professional traders and institutions know this fact, and that's why their main focus is on risk management. They know that the edge lies in probability and statistics, and not in any particular trading strategy. If you want the big money that the big boys earn, then you must be prepared to do the work that the big boys do. Before going into details, I want to know that you know where it makes the most sense to place your stop. Since we are trading price action in this course, it is important that we also understand how to use a stop loss based on price action. A stop loss is the point at which your analysis about price action is invalid. For example, you enter into a long trade after your analysis tells you that there is an uptrend because price action is making higher high and higher lows. Then your stop loss needs to be at the point where the higher high, higher low pattern is violated. Here is an example on your screen right now. And I've broken it down from signal analysis, trading decision, stops, and the reason for putting the stop there. Your reason to enter the trade was based on the fact that price action is showing higher highs and higher lows, which you define as an uptrend, and you anticipate that it would continue for as long as this is true. A lower low would break this pattern, and it is the point where you would need to say, my analysis is no longer valid. Therefore, it makes sense to put your stop below the last lower high. Let's look at another example. This time you are trading price action reversal. Indecision formed on resistance and your other entry criteria are also met. You decide to go short. Where should your stop loss be at? Here is the summary of the trade setup we are looking at. Your analysis is invalid if price can go higher than the high of the indecision candle. You enter the trade with the anticipation that price will reverse and that the indecision candle is the signal where the turnaround happens. Therefore, a higher high would invalidate your analysis even by only 1 pip. The stop should be placed at the high of the indecision candle. It is very tempting to be creative with your stop. This is something I see a lot of new traders do. When they see a setup, they want to either bring the stop closer to their entry or put it just beyond their resistance zone. While technically this is okay to do, it does not follow price action at all. If you have a lot of trading experience and you begin to notice that this pattern of placing a stop is profitable to you, then go ahead, by all means. You have proven that you can trade like that, and it has proven to you that it is profitable. However, when you are new starting out price action, you need to be very strict with how you place your stop. If you are trading price actions and price action is the signal that you look to enter a trade, then price action should be the signal that you look for to exit the trade and also to find where you put your stop. You need to be consistent with your analysis. Now that we know how to apply price action to place our stops, let's look at how we use price action to help us place smarter stops. We know that support resistance zone can act as barriers. Use this fact to your advantage and always be on the lookout to use support resistance to protect your stop whenever possible. By putting your stop beyond a support resistance level, you can effectively create a barrier to stop price from hitting it. Of course, this doesn't mean that it would work all the time, but doing this means that you are basing your decision on statistics and not by any other means. The use of statistics is involved because we identify support resistance by counting the number of instances that price has either stalled or turned around when it approached the level. After working out the percentage risk per trade and the size of your stop, the next step would be to work out the correct position size for the trade. This step is extremely important because the size of your stop and the currency pair that you want to trade will determine the position size that you should have in order to have the correct percentage of risk going into the trade. Calculating position size is very simple, and there are a variety of free calculators on many websites. You would need the following numbers: your account balance, your stop loss in pips, and the currency pair you are trading. You can find a link to the position size calculator that I use in the link below the video. There's nothing special about this other than the fact that it is well presented and I see the numbers that I need to see very quickly. Account balance is different to available equity because it does not take into consideration any profit or loss on trades that are currently open. For example, if your account balance is $4,500 and you currently have a trade that is showing $200 profit, then the available equity would show $4,700. You should use your account balance, not available equity, when calculating your position size. This is also true if you intend to have multiple trades open at the same time.